One of the questions I get asked all the time. What should I buy today? What should I sell today? What will the price of gold be tomorrow? Where will Google be tomorrow? Where will Facebook be tomorrow? What will the price of the euro be? Where will Bitcoin be trading? Well, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball, and neither does anybody else. So if you're attending this class in the hopes that technical analysis and candlesticks has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that candlesticks will improve your investing and trading, that I have good news for you. It will. Now, most new traders learn a little bit about candlestick analysis. Now, candlesticks have become the buzzword of the online trading market. When I started trading, and that was 1972, yeah, that was a long time ago, we did everything by hand. We did hand charting because there was no, first of all, there was no internet. Computers were these things that took up these huge rooms and had green screens, and you could push one and get some information, but they wouldn't do anything for us. And so we sat there using ticker tapes and hand charting on graph paper. So most of us didn't use candlesticks. They were too time consuming to draw onto a graph paper for all your own charting. But with the advancement of technology and with HTML and Java charts, the use of candlesticks has become very, very, very popular. And they are a great trading tool to help you make great decisions. They give you the best image or graphic depiction of what price is doing. But most people learn what we call pattern recognition. They want you to memorize what a doji is, what a harami is, what an engulfing candle is, what this candle is, what that candle is. But most of that is all useless. You're not going to ever be able to successfully trade in the Forex and CFD market, especially the short-term market and the fast-paced market. Trying to memorize all of these patterns, it's not going to happen. Okay. But candlestick analysis is a whole different story. So the standard approach to candlestick analysis is basic pattern recognition, which fails to work in real-world trading. But you can't skip straight to advanced candlestick analysis without knowing some of the basics first. If you don't know the basics, that's fine. I got you covered. In fact, if you look on your screen, you see the little box that says handouts. I've given you in there a handout that's called the Candlestick Cheat Sheet. It's all the patterns you're supposed to memorize. Now that's a nice little graphic formation. Just click the download button, download it to your computer. You can use it anytime later. But it's a great cheat sheet for you, and that's got everything you need to know if you want to memorize all the candles and what you're supposed to do. Now, when Forex traders first start out, they usually learn about candlesticks. But as I said, what they learn is useless. They normally see a list of candlestick patterns, which is your cheat sheet. And each pattern has a set in stone definition that is the only meaning it can have. Well, that's the problem. That's a bunch of hogwash. They teach you about hammers and inverted hammers, dragonflies, dojis and spinning tops and shooting stars and hanging mans and gravestones and spinning tops. Wow, and they go on because we haven't even talked about Marabuzu and 3 black crows and 3 white soldiers and the evening star and the morning star. It's mindless. But this isn't candlestick analysis. It's pattern recognition. Okay. So if you want to work like a robot and try to memorize these patterns and then try to see them on your charts and try to predict what the markets will do, because somebody said, when you see this pattern, you should be doing that. Go for it, I guess. But for a price action trader, it's totally useless. Now, that doesn't mean candlesticks are useless. Okay. Candlestick analysis using pattern recognition is useless, but candlesticks are great. So candlestick analysis is worse than useless. Thinking about a candle as just a pattern is counterproductive. it makes you a worse trader. It leads you to make massive mistakes. Why? Giving a pattern a set definition leads to tunnel vision. When you see that a specific pattern, you assume that something will happen. But that's not how candlesticks work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. So normally people see something that's called a spinning top, which is on your cheat sheet. And they say, or the definition is that a reversal is imminent, which can be true. However, the same pattern can also mean that a continuation is imminent. Okay? And the price is just temporarily stalled. It can mean a lot of different things. So thinking of candlesticks as simple patterns is a wrong way to do things. You need to look beyond the pattern and use candlesticks to read the story of price. And what's the story of price? Okay, now, I'm not going to sit here today and tell you how to draw a candlestick on your chart. Okay, we're going to assume you know how to draw the open, the high, the low, and the close, and what the wicks are, and all that other simple stuff. But once you've drawn a candle, you know what, I better take you over to a chart and make sure you got it. Okay. We're looking at a candlestick chart, and each one of these candles uses the open, the high, the low, and the close. And every candle is permanently the candle. So we're looking at, well, let's go over to, we're looking at a 12-hour chart. I hate 12-hour charts. Let's go over here and let's look at my 30-minute chart. Let's blow this up a little bit so you can see it better. Now, on a 30-minute chart, we take the open of that 30-minute period and we put a line across on the chart. At the close of that 30-minute, we put a line across on that chart. We put a dot at the highest price that chart, the price reached, and a dot at the lowest price. We connect the dots to the lines, connect the lines to the lines, and we form a candle. If the price went up from the open to the close, that's a bullish candle. If it went down from the open to the close, that's a bearish candle. Now, in today's world, we are typically using reds and greens. Reds mean bearish, greens mean bullish. But a lot of times when you read about candlesticks, they talk about black and white. Because back when we talk about the old days when I told you about hand charting, the people that drew candlesticks on their charts used a pencil. And when it was a bullish session, they just wouldn't do anything with the candlestick and they'd leave it hollow or white. When it was a bearish session, they'd use the size of the pencil and color it in. And so that was a black candle. So they were talked about black and white. And because it's black and white was around for so long, you have to understand the difference, because you'll hear about trading patterns that are called 3 black soldiers, 3 white crows. The names didn't change to become 3 red soldiers and 3 green soldiers and 3 red crows. They're still black and whites. But the fact of the matter remains that you could use chartreuse and let's come up with another weird color. Well, let's say purple. And you can make one of those colors bullish and one of those colors bearish. As long as you know which color you're using as a bullish and which color you're using as a bearish, it's unimportant. Okay. Now, this between the open and close is called the body of the candle. And these are called the wicks of the candle. So we have the body and the wicks, and together the bodies and the wicks cover the open, the high, the low, and the close for that period in which that candle is being drawn. So if we're looking at a 1-hour chart, that candle would cover a 1-hour period. If we're looking at a 15-minute chart, that candle would cover the prices for the 15 minutes. So right now we are looking at a 30-minute chart. So each one of these candles denotes the movement of that price over the 30 minutes. Now, we're not going to discuss today time frames. That's a whole different class on charting. we're going to be discussing candlesticks. Now, you can see that sometimes you see lots of red. Lots of red with candlesticks doesn't tell you it's bearish and you should be selling or you should be getting out of a position. Lots of greens doesn't necessarily mean it's bullish. Candlesticks are all about the placement of the candles in relation to support and resistance, in relation to the previous candle, and in relationship to the trend. It's about the shape of the body, the size of the body, and the relationship to the candles around it and price movement. Now, if we want to say that this is a bullish and a bearish engulfing candle, we could if we want to see pattern recognition. But I could see that this candle fully engulfed the previous candle. It's telling me something. But that something has a lot to do with where it appeared on our chart, where the open and the close were, what prices they were at. So if we throw this pattern recognition in the trash, not in the trash, we put it on the side. You know, there's lots of stuff that we learned in grammar school or in middle school that we don't use today, but we needed to learn that stuff in steps to get forward. I mean, we all took geography. How much do we remember from geography? We all took, you know, we had math, and then from math we went to algebra. From algebra we went to God knows what. I don't remember what we went into after that in high school. But you can't just jump forward. But we don't need to memorize a whole bunch of patterns. Now, every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. What is the price on the chart trying to tell you? What is the market trying to tell you? So the foundation for my candlestick trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital in Forex. It's vital because it allows you to answer one of the most important questions in trading. Who is in control of price? And that only has three possible answers: sellers, buyers, or neither. Being able to accurately answer this question is vital. And if you're about to enter a short trade, you need to ask yourself, who is in control of price? Your answer, if the answer is buyers, well, perhaps selling isn't such a great idea. So let's break down the story of price. Now, if you look at the three highlighted candles, it's easy to conclude that the sellers are in control of price. Okay? Doesn't help you make a trade. Doesn't tell you where to enter a trade, where to exit a trade, where to put your stop loss. It's just telling you something about who's in control of the markets and helping you interpret the story of price. We'll get to how you figure out the other things in a few minutes, but you have to first understand price on a chart. Now, if you look at these candles, the candles are all closed lower than they opened. So each one of these candles happened to have closed lower than they opened. Okay, we're all in agreement there. We also have three red candles. That's telling us the market is rather bearish at the moment. They all created new lows beyond the previous candle's low, and they all had small upper wicks in comparison to the body. The small upper wicks indicate that the buyers were unable to push the price back up much. Whether you're looking at a bar chart or a candlestick chart, you have the open, the high, the low, and the close. The high is where the bulls were able to push that price up to. But if the bulls weren't able to push it up too high, you would have a very small wick. So the small wick indicates that the buyers were unable to push price up by much. But what does the highlighted candle start to tell us. Remember, I said to you, it's not about the amount of reds and greens you have, because you would look at this, forget these right here, but you would look at these three candles and you would say sell, 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 downtrend, downtrend, downtrend. But our little buddy here is telling us something completely different. Okay. So what does the highlighted candle on the chart tell us? It has a short upper wick, very short, a small body, and a long lower wick. So number one, a long lower wick tells that the sellers were trying to push the price down, but they were losing their wind. A small body is a sign of market indecision, and a small upper wick tells you the bears, the bulls, tried a little bit, but they couldn't dominate the sellers. But they did, because the price fell this low that the bulls were able to pull it all the way back up here and to close higher than the open. So this is what we refer to as an indecision candle. This indecision candle is ultimately important, but only where it appears is ultimately important, because indecision candles pop up all the time. I mean, you could have a big run up, and what happens is you get an indecision, not because the market's reversing, not because anything's happening. The bears and the bulls got tired for a second. There was an economic piece of the report out, and they were doing this and doing this. Sometimes, people are leaving the markets at a strategic price, and sometimes they work. They happen all the time. So don't misunderstand that I'm saying whenever you see an indecision candle, the markets are reversing. They're not. Okay. It's where that indecision candle appears on your chart. So indecision candles occur when neither buyers or sellers can gain and maintain control of price. They are common, but if used the right way, they can be very powerful. So let's take a look at the bullish trend, and it's a strong 10, and there are several bullish candles heading towards an area of resistance. Okay. So we have price forming. Well, this is just, and this is not, I'm sure this is a graphic format, but this happens all the time. I'll take you over and show it to you on live charts in a minute. Then we get an indecision candle. So price is pushing, pushing, pushing. And where does it come to? It comes to a resistance zone. A resistance zone, where does resistance come from? It comes from your support and resistance levels. Okay. And let's go over and look at a live chart again. Now, we have here, now I always have all the time drawn on my charts, support and resistance levels. Now, we have price falling. Look at that fall, but we're only looking at a 30-minute chart, and price still hasn't come all the way back down to where it started the day out. But if we were looking at this earlier here, and we got this indecision candle right before it came to that level of resistance, that tells us something. In this case, we see no indecision candle. That tells the market's going to most likely keep on going down. Okay. Because we're looking not for a specific pattern. Okay, we're looking for a specific candle, a one-off candle that appears in a certain place at a certain time. Okay. Because you can see, we call all of these indecision candles, call that anything with a small body, small upper or lower wick can be called an indecision candle. Okay. But these don't tell us anything. It's only when it appears at our support or resistance level is it of any value to us. So you need to have your support and resistance levels drawn on your charts. So as we can see here, price was moving, 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 moving. We got an indecision candle right on our, just trying to make this easier for you to see, right in our resistance zone. and then price reversed and moved back up. Now, in this case, what do we get? We got nothing. The indecision candle's down here. Doesn't tell us anything. I'm just trying to come up to current prices. Now, so what we would be looking for now is an indecision candle that would form right here on our resistance level. Because we have 3 bearish candles. We have no indecision candle. So we're not getting a clue as to what to do. Okay. Because price action and price analysis has a set of rules. And what you're looking for is, now you can have many different sets of rules. You have one set of rules when price is moving this way or that way, and you get an indecision candle directly on your support or resistance, then I'm going to do this, this, and this. You're going to have another one that says when I have 14 candles going up, and then I got 3 candles going down, I'm going to do that. You have all different strategies or all different interpretations. But today we're looking at the 1, 2, 3 indecision rule. Okay. Now, this is just to start. You haven't made a trade yet. Okay. But this is one of the ways you use candlesticks to look for a possible trading scenario. So when we have either a move straight up, and it can be intermixed. You could have 5 green candles and 3 red candles, as long as it's moving upward or moving downward. Okay. And you get the indecision candle right on your support or resistance level. That's the only time that it can make. So when price hits resistance, we get an indecision candle. So let's break this candle down into stories so you understand why it indicates indecision. Okay. You have a large upper wick. So a large upper wick shows that the buyers tried to continue the bullish trend but failed. Sellers took control of price and pushed it down. You have a small bearish body. The small bearish body shows that the sellers were unable to close lower than the open. And this is significant because in the 3 candles before, this price consistently closed higher than open. This shows us the buyers are losing power. And then we have a small lower wick. The small lower wick shows that the sellers were not able to gain much ground either. This tells us that the sellers are not strong enough to turn price around completely. However, they are strong enough to stall further buyer movement. So we have upward movement, the indecision candle directly on the support or resistance zone, and all together, this indecision candle forming right after a strong bullish candles suggests the power has shifted decidedly from bullish to an undecided market. We didn't say bearish, to an undecided market. While sellers are not in control, neither are the buyers. But there's one more thing we need to look at. The indecision candle is forming on top of a resistance area. So if you remember, we talked about resistance being a sell area and support being a buy area. So the image shows us 3 strong bullish candles heading into a resistance area. And then, boom, the price stalls and we get indecision forming on top of that area. This tells us that the sell area is working. When price pushed into the area, sell orders were triggered and buyers could no longer continue up. This is what the story of price on the chart is. And the story gives us a nice little price action trade setup. Now, price action allows you to make many different types of trades. You can do reversals, continuations, range, swing, breakouts, scalp trades, just to name a few. So what we're looking at building into this is how to spot a reversal trade. Because You can have all sets of rules for every different type of trade scenario possible. It's only, okay, this one works today. So when this one works, or this is this is not what works. This one fits what the candlesticks are doing. So what am I going to do, or how am I going to respond? So reversals occur quite often. But if you don't know what you're to look for, you cannot trade them. Reversals are one of the strongest price action setups and one of the easiest trading because they occur so often. You can trade this setup exclusively and be a profitable trade. In fact, for years, my Forex trading strategy focused only on reversals. However, these days I trade more more price action setups. Reversal trades come in three parts: the preceding trend, the indecision candle, and the reversal trend. So what is the preceding trend? The preceding trend in here is a bullish trend heading into an area of resistance. Again, in my examples, we're looking at three candlesticks. It could be 5, it could be 7, it could be 3 green and 3 and 5 red. Doesn't make a difference. It's the preceding trend is the definition, not a trend line. And you need to know the difference between a trend line and a trend. A trend is just where price is moving in general. The preceding trend in this case is a very strong, this case was a very strong bearish trend, okay, indicating there are lots of bears in the market and few bulls. If the bulls were strong, then price would not be trending down. The preceding trend shows the bears have strong control of price and they are pushing price down. The opposite applies for a bullish preceding trend, and which would show that the bulls trending towards resistance, as you see here. So a preceding trend can be formed as little as one candle. I don't ever use one candle. My rule of thumb is 3 because it's not a trend line. It's just the trend. Okay. If the candle is strong and covers a lot of distance, I categorize it as a preceding trend. The example below shows a single candle price trend. Okay. You can, I don't. Preceding trends are simple. If you see a strong move headed into an area of support and resistance, you can consider it a preceding trend. Then you need your indecision candle. A reversal setup will have one of 3 indecision candles. The indecision candle needs to form on or near the support or resistance area. If the indecision candle does not form on or near the support or resistance level, it's not a valid reversal setup. It's a valid indecision candle, but it's not a valid reversal setup. Why does it need to be on the support or resistance area? An indecision candle is a bullish preceding trend, indicates that the buyers are possibly losing control and sellers may be gaining. In a bearish preceding trend, it indicates that the sellers are losing control and the buyers may be gaining control. However, an indecision candle does not indicate that price will reverse with any great degree of certainty. An indecision candle indicates only one thing. What is that, everybody? Indecision. Okay. So we've got the preceding trend. We've looked at candles. We've looked at the body size. We've looked at bullish and bearish candles. And now we've looked at the indecision candle. Okay. But we still haven't gotten anywhere near talking about how to make a trade. So once we get our preceding trend and our indecision candle, and see, you can see in this example, we get indecision candles all over the place. Okay. In the middle of trends. If it's not on a support and resistance area, it's got no need for us in a reversal setup. So you cannot take a trade based on solely on indecision. Now, we cannot enter just yet. We need confirmation. We haven't made any determination yet. Okay. What we need is the reversal trend. The reversal trend is the third and most important part of a reversal setup. This is where we make our profit. After a preceding trend stalls at support and indecision forms, you often see a reversal trend. The image in the background shows a bearish reversal trend forming after indecision at a resistance. Price pulling up, indecision candle. Third, but we can't, if we're trading at the wall, we don't see this, this, and this. Okay. And trading at this level, it's way too late for us. So how do we know when to act and react? In this case, we saw a transition from the power of the bullish preceding trend to a bearish reversal trend separated by a stall on resistance. But where do you enter a trade? Where do you make a decision? Well, you know what a reversal trade looks like. You know that you need to enter after indecision and before the reversal trend. Okay. Now, this is where it gets really tricky. Because remember, most trading setups overall need to give you profitability, but you're not going to make a good trade every single trade. Okay? So you have to be able to judge your setup. Say 10 times you used it and 6 out of 10 times it was successful for you. The 4 out of 10 times it failed, but you got out with a very small loss. So my trading strategy was built on reversal trading. It has now expanded beyond reversals, but reversal trading is where it all started. Entering a trade does not need to be difficult. Remember, my goal is to keep everything simple. Ultimately is getting in at the right time. So we saw the preceding trend, the indecision candle, and we started to see the beginnings of the reversal trend. But if you wait for that whole reversal trend to happen, you're way too late. So you have to get in at the right time. So I explained that a reversal comes in 3 parts: the preceding trend, the indecision, and the reversal trend. You need to enter the reversal trade after part 2, the indecision candle, closes. But before part 3, the reversal trend completely takes off. Obviously, if you enter after the reversal trend takes off, it's way too late. You also need to make sure you do not enter too early, as you could be entering a false setup. So this is where it gets really tricky. So here, if you would have entered here and entered a reversal trade, you would have lost your shirt. Because what happened? The trend continued downward. So failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in. But I have tested this thoroughly and waited for closes to get you in too late. So what we're hoping for is we get the indecision candle. It closes. We definitely have indecision. Okay. And we want to be able to take advantage of this next move. Now, this next move could be against us. But if we set our stop loss close enough and we set our buy to enter above the resistance level, if it continues downward, then we never get a trade entered. If we set up our limit order to enter at this price above the resistance area, okay, we get in and we can take advantage of this entire move. This means if you waited for the end, you can miss out on a lot of potential profit, which is obvious not good. The key to reversal trading or any trading is a matter of getting in at the right time. So how do you do that? I have tested countless entry methods in the last 15 years. In that time, I found 3 awesome entry strategies: entering on a new high and low, retrace entries, and distance entries. When indecision forms on the area of support or resistance, you can use a high and low of the indecision candle as an entry trigger and a stop loss. So in other words, move up, indecision candle. Set your stop loss, since you're trading it to come down in reversal, your stop loss at the high of that indecision candle. Enter at a price lower than the low of that indecision candle. So you'd enter here. So if this next candle continues upward and doesn't reverse, guess what? Your trade was never executed, so you didn't have anything to lose. So we set our entry point and our stop loss. Now, the other thing we have to figure out is where we would set our limit. Or our limit or our target price would be at the previous or the next in the direction it's going resistance zone, because we have to always make sure that wherever we're going to set our stop loss and our entry point, that we have a target point, because we need to be able to calculate our risk reward ratios. So in trading, highs and lows are very important. If a new low is created from resistance, it indicates sellers have taken control of price, which means that we want to be short. Our stop loss sits above the high, as a break of that high would indicate buyers have regained control of the market. For long trades, you set your entry a few pips above the high of indecision and a few pips below the low. It's the simplest form of trade entry, but it also is the most effective. So where to set your target? Targets are easy. You need to make sure your target comes before the next major barrier, like the next area of support and resistance. So once you've got that on your chart, you can then calculate your profit and loss ratio to see if you can afford to even make this trade. You cannot set your target beyond the next major resistance level. So I always start out with my trend line, then my support and resistance levels, then I look for my price action. Finally, there's one clue you want to have before you actually execute a trade. Look for volume to confirm. You should see volume increase. Okay. In trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of anything you would intuitively know, but many things are easy. You just need to know what to look for. You want to make sure you're always putting a stop loss, controlling your risk, and getting in at the right point. And if you use a smart entry point and you understand what you're doing, okay, you'll execute your trade at the right time. And if it goes against you, even if it gets executed, your loss is minimal. And you need to test your strategy over and over and over again in many of the same exact situations to make sure that overall that strategy is giving you a cumulative success, not a cumulative amount of pips. How many times is right and how many times it's wrong? Because risk management, money management are the ultimate tests in this market. So thank you very much for joining us. I hope I gave you something to think about. And click the download button, download that Candlestick cheat sheet. And I also gave you the technical analysis guide, which is a great resource guide from investing.com. And it'll tell you all about support and resistance, all about charts, all about candlesticks, all about everything you want to know in the field of technical analysis. So download it. It's free. There's nothing you have to put in, nothing you have to pay for, no emails, no codes. Just download it and use it at your leisure. Thank you very much and have a great trading day. And thank you for supporting Legacy as well as investing.com. Bye now.